So let's take a close look at the differences between service and merchandising companies. And in this case, we're going to focus mostly on the merchandising company, but let's just cover a couple of points. The first things first, service companies, they provide only intangible services. They cannot be, physically stocked as an inventory or sold or purchased or resold to the customers. What happens is that merchandising companies, they buy inventory, they sell inventory, they sort of stock those inventories in their in their facilities. Now, services don't have that step. They don't provide that. So the service companies, they have this operating cycle. Yeah. So let's just cover in this side what operating cycle specifically means. Yes. So operating cycle. I just don't want you to confuse it with an accounting cycle. Operating cycle is the amount of time, yeah, so time, the amount of time it takes for a company to use its cash, yeah, so they use cash, yeah, use cash, and then provide the product, yeah, and the outcome is the product or service. And finally, service, and finally, collect payment. Yeah, so this is basically the time. So they use the cash, they provide certain product or service, and finally they collect the payment. Whatever the amount of time it is, yeah, that takes to complete the cycle is called the operating cycle. Very briefly. Now, when we look at the service company's operating cycle, we will find out that it starts always the cash. Yeah, so available cash that they have in their business, they have invested in their business. Next, they provide service. Since this is a service company, yeah, let me just type it correctly. Provide service, yeah. Next, we're moving on to, well, it could be it could be skipped, but let's say most of the companies, they go through the account receivable, yeah, because they might be selling it on account. And finally, collection of cash. So this is collection. And then again, they collected the cash. Again, they have an available cash, and then they sort of continue with the same circle of providing the service. They have an account receivable, and maybe they don't, they immediately just collect cash. But whatever the time it is, whatever the steps are, this is the operating cycle of the service companies. Now, if we look very closely at the merchandising companies operating cycle, you will see that there is one specific sort of step or two actually that adds into this cycle. So again, it all starts with the available cash, yeah, available cash. Then what happens is that because now we're talking about merchandising company, so let's say that this is company called Bravo, yeah, so they have, this is a retail store where they this is a supermarket store that we have in Baku City. Available cash they use to purchase. First, they need to buy that inventory. Yeah, they purchase the inventory. Second, after that, they sell that inventory to us. Inventory. And then we add that, yeah, so account receivable, and then possibly, not possibly, but most definitely collection of cash. And finally, again, that collected cash becomes available cash, and that circle continues. Just to point it out, just to see it and emphasize that we have here purchase inventory and sell inventory. These two are different, yeah. And in the case of the services, we only provide services. That's it. These are the differences between service and merchandising in terms of the operating cycle. Now, if we look at what it will be like in the income statement, it's actually very simple for service companies. Income statement, well, snippet from the income statement, or like, let's say the very brief sort of graphic representation of the income statement for service companies will be what? We have sales. Yeah, let's just imagine this is our very small, very tiny, not detailed, but just in sections divided. Sales, let's say we have, let's say $30K, right? So the $1,000. Then we have expenses that we deduct from our sales. Let's say 150K that we sell, that we spend, and then finally we have our net income. Yeah, net income is 150K. That's it. This is our income statement for services company, a service company. And if we look like we take a close look at the merchandising companies, their income statement is going to be a little bit more complicated, because we have to account for something extra. Yeah, income statement for our merchandising companies. What we're going to have is, again, we have sales. Yeah, so that doesn't change. Let's say that we have 300,000K of sales, but we also now, this is a new, let's put it in green color. Let's say we have now cost of goods sold, meaning those inventories that we bought for. So when we first purchased the inventory, we purchased obviously for much cheaper price than when we sell it. Now and then again, to prepare it for the sale and everything, let's say we have a specific type of the employee that has to be counted, and his salary or her salary has to be counted only in the cost of goods sold. That's going to be added in here, right? So let's say that is 50K. And here we're going to have our gross profit. Yeah, gross sales, gross revenue. And so we're going to count it here. Let me just change the color again. So we have gross margin, or gross margin revenue, gross revenue is going to be 250K. Yeah, so this is going to be deducted. Yeah, this is going to be deducted, and we have 250K. Only after that we will count for our expenses. Expenses will be counted, and let's say the expenses are 100,000K, 100,000K, and 100K, and then net income will be calculated only. Oh, sorry. Let's just move it down, and net income will be only calculated after, gross margin 250 minus 100 is going to be 150K is our net income. So again, very briefly, you can see we add one additional step, and we also calculate gross profit or gross revenue, gross margin, and that's going to be 250K in our example. So this is basically it. If we want to see what kind of effect the activities or operating cycle of service companies and merchandising companies have that distinguish them from each other, and it also is reflected in the income statement. And again, in the service companies, they don't provide any product, they don't provide any inventory that they sell. That's why we do not count for the cost of goods sold. All of the expenses related to our services will be disclosed under the expenses, whereas in income statement, every cost related associated with sale of this inventory is going to be added into the cost of goods sold, and that's how we're going to count our gross profit and gross revenue.